All right, let's get right into it. Today, we're taking a look at the latest earnings report from the customer experience company Concentrix. The numbers just dropped, and honestly, they paint a pretty fascinating picture, which leaves investors asking one big question.
So, what's the deal with Concentrix? Is this a hitting bargain just waiting for a savvy investor? Or is it more of a falling knife that you really don't want to try and catch? The results were a mixed bag, to say the least. So, let's break down the numbers and see what the source material has to say.
Okay, so here's the breakdown. On the one hand, you've got the good news. The top-line revenue looked pretty solid, coming in at $2.4 billion, which was right in line with what Wall Street was expecting. But on the other hand, the bottom line, the actual profit, it fell a little short. Earnings per share came in at $2.40, just a little bit under what analysts were hoping for. So what we're seeing here is strong sales, but profits are getting squeezed.
Now, with a split result like that, you can pretty much build a case for either side of the argument. So first, let's dig into the bull case. We're going to look at all the reasons to be optimistic based on this report. Here's where things get interesting. You'd think a profit miss might make management a bit cautious, right? Nope. They actually got more bullish. They raised their sales guidance for the next quarter, expecting up to 2% growth. And get this, they even boosted their full-year sales forecast to $9.8 billion. That's a huge vote of confidence coming straight from the people running the company. So you might be asking, where's all this confidence coming from? Well, our source points to some really healthy fundamentals in the business. First off, the sales pipeline is still solid. And second, those big strategic projects, like integrating new partners and all that, they're moving along right on schedule. Basically, the core engine of the company seems to be humming along just fine.
But of course, it's not all good news. Let's flip the coin and look at the other side. This is the bear case. All the reasons for caution that are putting pressure on the stock right now. Before we get into the details, let's do a real quick refresher on a term that's absolutely crucial here: profit margin. Simply put, it's the percentage of every dollar in sales that the company actually gets to keep as profit after all the costs are paid. It's a key indicator of financial health, and it's right at the heart of the bear case. And this is exactly where that profit margin comes into play. While management was feeling good about sales, they were also very clear about some short-term problems. They actually trimmed their profit margin outlook, and they pointed a finger directly at tariffs as a key reason for that squeeze. That pressure on margins, that's exactly why they missed their earnings target. Now, all this financial uncertainty is making its mark on the stock's price chart too. According to the analysis in our source, the chart is looking a bit shaky. There's a real chance the stock could fall even further and test a key support level down around $37. Think of a support level as a kind of historical price floor, a point where buyers have often jumped in the past. Having to test that level adds a whole other layer of risk. So we have two completely different stories going on at the same time. On one side, a solid core business with a confident sales forecast. On the other, you've got this profit pressure and a pretty nervous stock chart. So let's bring it all together and see what the analyst's final verdict is. When you boil it all down, the analyst's take is a classic tug of war. The risks are right here, right now. You've got that margin pressure and a weak chart creating a lot of volatility. But the potential reward? That's all about the long term. It's built on the belief that today's price just doesn't reflect the true value of the company's solid core business. And honestly, this one quote from the source sums up the entire idea perfectly. For patient investors, that weakness could be a gift. Today's price screens low risk versus upside. That word, patient, that's the key to this whole thing. The analyst isn't seeing this weakness as a reason to run away, but as a potential window of opportunity.
And they're not just talking in hypotheticals, they put a hard number on that opportunity. The analyst's 12-month price target for Concentrix is set in a range between $75 and $80. That suggests some pretty significant upside from where the stock is now, all based on the idea that once these temporary margin problems get ironed out, the stock will rally to reflect its real value. So there you have it. The source material is pretty clear. It sees the current weakness as an opportunity for anyone willing to play the long game. So the final question, after seeing both sides of the story, is what do you see? Is that short-term risk worth the potential long-term reward? Thanks for joining us for this explainer, and we'll catch you on the next one.